Welcome to Business Matters. Today, we will be looking at the role of non-banking financial institutions. To guide our lesson today, we'll be seeking to determine a few objectives. Identify the various non-banking financial institutions. Describe the functions and services offered by non-commercial banking institutions. Describe the role and functions of the financial regulatory bodies. Let's begin. What are some non-banking financial institutions? Well, 1. Credit union. 2. Insurance companies, building societies, micro-lending agencies, government agencies. Let's begin by looking at the credit union. What is the credit union? It is a financial cooperative which is made up of a group of persons who join together to make certain financial services available to themselves. Now, this organization uses the resources that their members pool into a common fund. Now, this fund may be accessed by its members as needed. Now, the credit union operates under the guidelines of the Registrar of Cooperatives. Now, the major services offered by the credit union are 1. To provide a facility to save money. To make loans available to the members at a rate of interest lower than the commercial rate. To provide insurance. They also seek to provide credit and debit cards. Now, how do you go about joining the credit union? The members must invest a sum of money, and this sum of money is broken down into units called shares. Under the principles and practices governing cooperatives, this investment allows the members to become owners of the credit union. Regardless of the number of shares held in the credit union, each member has only one vote. So, if one owner has $1 million worth of share and another has $10 worth of share, they all have equal vote in the credit union. Let's now look at insurance companies. Now, what is insurance? Well, insurance is a contract represented by a policy in which an individual or entity receives financial protection or reimbursement against losses from an insurance company. Now, the company pools clients' risk to make payment more affordable for the insured. Insurance policies are used to hedge against the risk of financial losses that may result from damage to the insured or his property, or from liability for damage or injury caused to a third party. So, in other words, the insurance policy is seeking to cover and to protect the insured against financial loss, against damage to their person or property, or to a third party. Now, building societies. What are building societies? Well, They are financial institutions that is owned by its members as a mutual organization. Now, when building societies first started back in the 18th century, they were created by groups of people who wanted to help each other buy property. So what we're seeing here, the genesis of building societies, were really about helping the members to build houses or to acquire property. Now, members could pay monthly subscriptions to a central pool, of funds. So they put their money to a central pool of funds, and this would then be used to build houses for members. Now, the main thrust of a building society is to lend money for the purchase of property and to build homes. The institution lend the funds in the savings accounts of two members applying for mortgages. So what happens is that each member will be opening a savings account, and that the monies that is from the savings account is used to lend to any member who wishes to purchase a property or to build a home, etc. So they get a mortgage. Now the borrowers are charged interest for borrowing. Now the building society is considered to be the equivalent to a savings and loan association. So there are two main things that they are doing. They are offering saving, ability to save, right? So they offer you a savings account, and they also provide loans for the members. Now, people often choose to become members of the building societies because the chances of obtaining a mortgage are often much better. Isn't that good? Indeed it is. Now you have what is called pension funds. Now the capital for pension funds is from the contributions of employees' income deductions throughout their working life. Now the pension funds, they provide a guaranteed monthly payment to the retiree. Let me pause to say, what happened here is that a pension fund, the employees are paying over these monies, and so the monies will be held for a longer period of time, and so the company invest this pension fund, yes, in order to gain more income to provide and to sustain the pension fund. Now we have what is called unit trust company, another entity, and small investors purchase units. So in a unit trust company, the small investors purchase units, which represents a portion of the trust. Now the funds received are by securities. Okay, so in other words, they use the funds that they collect from the investors are used to buy securities, and these securities now being invested into other entities and other businesses earn income for the trust. The dividends earned from the securities, yes, are distributed among the unit trust holders. Now we move on to investment trust. This entity is similar to the unit trust. Now the difference is that the investors are shareholders of the company. So in investment trust institutions, the investors become part owners, they become shareholders of the company. And then we have what is called venture capital firms. Yes, and this is a type of investment firm that fund and mentor startups or other young companies. Now the company invests in high risk businesses that has a potential to grow quickly. So what happens here with a venture capital firm, they have the capital, the resources, the funds. They identify these entrepreneurs who have a great potential, a business idea that has a great potential to be successful, right? And so they will invest in that company, all right, to give it the leverage to be able to operate and be successful. Now, they invest with the hope to get a share of the ownership of the business. So what they do is they put in the capital into the business, assist the entrepreneur to start up the business, function it, and they will make profit. And in the event, what they seek to do as well is to become part owners of that lucrative business. Now, micro lending agencies, what are these? It is micro lending agencies is the process. When we talk about micro lending, it is the process of granting micro or small loans known as micro loans to those with financial needs. So micro loans are really small loans that are given to, businesses and small businesses and entrepreneurs. Now, these loans are generally used by entrepreneurs with a business idea, yes, or those who need extra cash to expand their business. The concept microfinance is where a banking service provided to unemployed or low-income individuals or groups who otherwise would have no other access to financial services. So microfinance is really an entity that seeks to help get started, yes, people who are unemployed or who have low income, and to guide them into starting a business. Merchant banks. Well, these are financial institutions that provide capital for traders, yes, and merchants. Now, other services such as accepting deposits and fixed deposits, they provide, and of course, medium-term fixed interest loans, right? So the merchant banks provide medium-term fixed income loans, interest loans rather. Also, they trade in foreign currencies. Merchant banks provide advice on investment, on property, or the stock market. Now we move to development banks. Now, development banks, it is a national or regional financial institution designed to provide the medium and long-term capital for productive investment, often accompanied by technical assistance. So a development bank then is a bank that is seeking to assist, right, with medium-term and long-term capital for companies and even for countries. Now, the major focus of a development bank is to finance capital development projects. So like, for example, the government may access the Caribbean Development Bank, funds from the Caribbean Development Bank, yes, and they needed those funds perhaps to build roads, to build hospitals, to build schools, right? Capital investment. Or companies and corporations may seek to obtain loans, perhaps to build plazas, malls, and those kind of things. Yes. Now, they will finance projects such as agricultural projects rather. Manufacturing startup or expansion, they'll finance as well. Building of hotels and housing developments. So what we're talking about here are some ideas or some of the areas in which development banks may lend financing capital, the purpose for which they will lend it. They'll lend it for agricultural projects. They'll lend it for manufacturing startup, yes, or expansion, or they'll lend for building of hotels and housing developments. They also will lend for road infrastructure, as we spoke about it earlier. Now, the government also plays a role in non-financial, non-commercial banking institution. The government also has some institutions that provide financial services and assistance to the general public. And here are what we're saying here is that these financial agencies put in place by the government to manage certain financial services, yes, offered to the public. So these financial agencies are put in place by the government to manage, yes, certain financial services offered to the public or to the citizens. For example, we'll talk about the Student Loan Bureau in Jamaica that is used to provide loans for students who are going to college and universities and give them assistance for their education. Jamaica Custom Agency, JCA, is also a financial agency of government that seeks to manage the movement of import and exports in and out of the country, and so manage the monies where that is concerned, the taxes, yes, that needs to be collected. The Jamaica Deposit Insurance Corporation is another example, and the National Health Fund. All these are financial agencies of the government. Now, may we now move on to look at the role and functions of financial regulatory bodies. Now, let's look at the essential role of regulatory bodies. Now, why are they in place? They are there to monitor, control, and guide various industry sectors. Yes, so to monitor, control, and guide various industry sectors in order to protect consumers. So government put in financial regulatory bodies to benefit the consumer. Now, functions of regulatory bodies. Now, the function of regulatory bodies are to enforce the regulations or laws put in place by the government, passed in Parliament, to regulate these bodies, yes, and license. So they are work to enforce regulations rather, and licenses of various financial activities, including depository lending, collection, and money transmission activities. So institutions that deal with depositories, institutions that are dealing with lending and collecting of monies, institutions that are dealing with the transmission, money transfer activities, yes, they are regulated, right? The government has put some agency in place to regulate them. Now, types of financial regulatory bodies. The central bank. The central bank is one of the regulatory body that government has put in place to control the financial institutions. Now, the central bank, its role and function, we have discussed this earlier in another video, so we're going to move on. But they play a pivotal role, the central bank, in regulating, particularly, yes, the commercial banks. Yes. All right. But also, and other financial institutions, let me say, not just the commercial banks, but other financial institutions. Now, there's also another regulatory body such as Jamaica Deposit Insurance Company. Yes, they are also a regulatory body. And what do we know about the Jamaica Deposit Insurance Company? Well, their responsibility is they offer protection and coverage against your money through deposit-taking institutions that are regulated and supervised by the Bank of Jamaica or the central bank through 5 accounts ownership categories, right? So the Jamaica Deposit Insurance Company, yes, they seek to protect the consumers or the clients, yes, in terms of the individuals who are opening their accounts, or if it is in relation to a joint arrangement or a trust or businesses or nominees account. All of those accounts of individuals, joint accounts that are trust, accounts for businesses, and so on. So the Jamaica Deposit Insurance Company seeks to protect these individuals, these groups. All right. Now, the deposit-taking financial institutions regulated and supervised by the Bank of Jamaica are members of the deposit insurance scheme. So one of the requirements is that these financial institutions must be a part, yes, must be members of the Bank of Jamaica or the central bank, and they must be a part as well of the deposit insurance scheme. They are required to join or to be a part of the insurance scheme. All member institutions, beg your pardon, are issued with a policy of deposit insurance. So all the institutions, yes, must become a member. Financial institution must become a member, yes, and they are issued with a policy of deposit insurance, as well as a certificate of deposit insurance, which must be permanently displayed. At all locations. So we have another financial regulatory body, the Finance Service Commission. Financial Services Commission is another regulatory body. Now, what do they do? Their mandate, yes, is to supervise and regulate the securities, insurance, and private pensions industry. So the Financial Services Commission seeks to supervise, yes, ensure that the institutions are operating appropriately by the laws of the land, yes, and they regulate the securities and insurance and private pensions. So all of these institutions that offer buy and sell shares, offer investment instruments, and so on, they are regulated by the Financial Services Commission. As we move on, we want to say that they have a responsibility, that is, the FSC has a responsibility to manage the proper administration of the pension security and insurance law. So in other words, they are there to ensure that the laws relating to pensions and securities and insurance are upheld by the players in the market. They also provide oversight, yes, to these entities by administering a number of statutes and accompanying regulations. The FSC Act and the Pension Act and the Securities Act, the Unit Trust Act, and the Insurance Act are acts that are existing, and the FSC must ensure that all the entities comply with these acts. The FSC also handles customer complaints and provides the public with important financial information. So they are not just interacting with the institutions in the respective financial institutions, but they handle customer complaints and provide the public with important information about their functioning. So we have come to the end of our class on non-banking financial institutions. And I hope that it has benefited you. And if you like this video, please click the like button. And just so, if you think the content is good, we ask that you will click the subscribe button, and you'll see us upload other similar content information that we know is pertinent for your development in the business world. This is our presentation from Business Matters. Thank you.